This is FRM Part 2, Book 2, Credit Risk Measurement and Management, and the chapter on wrong way risk. Typically in the finance profession, we use words like securitization and delta hedging and rehypothecation and heteroscedasticity, although that's an econometrics term that we seem to use pretty regularly. These are words that were probably crafted or created by really smart finance professionals or maybe even academics. Wrong way risk to me sounds like something that I could have created when I was about 10 years old. But it's a really good word. It's a really good term. And the beginning of the chapter has a really interesting example. And I'm paraphrasing here. It's just a short phrase, but I think it's worth repeating. The phrase goes something like, if you put some bread in the toaster and you pull it out and you put some butter on it and some jelly and you accidentally drop it on the floor, it almost always lands on the buttered and jelly side. And that's the first couple of paragraphs in the chapter where it's explained that, this is what wrong way risk is, that you have one adverse event, the toast falling on the floor, and then it's compounded with another adverse event that it lands face down. Of course, if it only lands face up, then as those of you who are parents know that 5-second rule, if you pick it up, you can still eat it or feed it to your children or however that works. But the first couple paragraphs in the chapter I thought were really fascinating in that there have been some academic studies that actually drop buttered and jellied toast on the floor. And of course, it comes up about 50% of the time, heads or tails, right? And then in one of those last introductory paragraphs, there's a conversation on a behavioral scientist who comes in and interviews people and says, what do you think is going to happen? And of course, most people say, oh, of course, it's going to land face down. So wrong way risk is really just an element of a series of adverse events that are probably correlated, and we'll talk about that. And so look at the learning objectives there. The good news for you guys is that in the previous couple of chapters, we had to reduce the font size on the learning objectives to really, really small so we could fit them all into one slide. Here, look at this, just 4 of them. Describe wrong and right way risk. Let's take a look at some examples. And then what's probably important from our previous discussions is how does collateral help us manage this wrong way risk? So once again, identifying the risk, quantifying the risk, manage the risk. We're in that kind of a conversation. All right, let's go ahead and give this textbook definition. All right, so I'm going to go ahead and read that first block point here. This is a risk that occurs when the exposure to a counterparty is adversely correlated to the credit quality of the counterparty. So you and I have a contract, some derivative contract, and the underlying asset is moving in your favor. So I owe you this substantial amount of capital, and then it moves against me and I owe you even more substantial amount of capital. And then something bad happens to me that's unrelated to you, but it's related to the underlying asset. So we have this adverse correlation. So look at the circle point. It's the risk that default risk and credit exposure tend to increase together. All right, so it's, of course, going to increase counterparty credit risk, and then this brings in the specter of all of those topics that we've talked about in previous chapters, those XVAs and CVAs, credit value adjustments. Remember how we defined those? The change in the market value of a derivative, so an option or a futures contract, to account for this counterparty credit risk. Now, there's also a debit value adjustment in which the derivative price is a function of the institution's own default risk. Of course, that must hold true. Now, right way risk exists when there is a positive or a favorable correlation or dependence between exposure and credit quality. And the textbook, of course, mentions Murphy's Law. I'm guessing all of you people throughout the entire world have some version of Murphy's Law that, when things go bad, they just go bad. And when you need them most, then things go bad. And I'm always thinking of that, of course, when we have a stock market crash like we had in 2008 and like we had in early 2020, that, boy, we really rely on that diversification as regular old individual investors. But when we need that diversification, what happens? All of our asset prices crash, whether it's a stock price or a bond price or an investment in, how about this, a barrel of oil or whatever it is. So here's just a quick illustration of upward sloping, so wrong way risk. Notice the horizontal and vertical axes change in exposure and change in credit quality, so that's an upward slope. Right way risk would be a downward slope. And then if we don't have any correlations or an independent case there, that would be in the middle with that. Boy, is that a circle or is that an oval? I need to get my glasses fixed. All right, let's take a look at some examples of wrong way risk. And this is pretty much what the chapter does for you in the first couple of pages. How about a put option as an example of wrong way risk? So this is what we do. We buy a put option. And remember, when we buy a put option, of course, we benefit when the price falls. And so what happens if the underlying stock on which that put option is written is a function of the performance of the counterparty? This should be an obvious case of wrong way risk. So what happens? That let's suppose that I buy a put option from you guys, and you are the global bank, and I have a put option on the shares of gigantic bank inside of the global banking industry. Well, if the gigantic bank stock price falls, well, that's good for me. But if it falls and there's contagion in the industry, then that's going to leak over into your bank, global bank. And so right when I come in and say, hey, I want to exercise my option, you're going to say, sorry, we're out of business. Put option. So this is like the traditional and the standard way of describing wrong way risk. And there's a good picture of put options that we've seen a million times before. Notice the second block point down there, macroeconomic factors, interest rates and inflation and contagion, which is what I just talked about. Now, this also holds true in foreign currency transactions, especially as it relates to swap, because what can happen is that, in this cross-currency swap, not only are we agreeing to exchange two underlying currencies, but we're also exchanging the notional principal at initiation and at the end of the tenor of the swap. And so remember, we're going to agree to exchange, fixed for floating or floating for floating, or however we want to arrange those intermediate cash flows. But of course, if we have conditions that make a particular currency, in this case, the Peruvian sol, if that depreciates, then our exposure increases significantly. How about a total return swap? I always thought these were fascinating. I love teaching these to my students because in a total return swap, look at the diagram at the bottom. You're going to pay a total return on some underlying asset like the S&P 500 index or Jim's equity index or whatever it is, and you're going to receive, some other kind of a floating rate. And it could be like a fixed income rate, like LIBOR plus 5%, but it could also be, you could swap the return on the S&P 500 index for the return on the NASDAQ index. Or remember, we're in the over-the-counter market, so we can swap almost anything that we want. And so you think about this. In this particular example, when we're receiving something that's tied to the fixed income market, like LIBOR plus 5%, if we start seeing a global rise in interest rates, then this is good news for us, because we're going to be receiving more than the total return on that index, because if interest rates start to rise, then equity indexes, they tend to fall, right? Well, what happens if that rise in interest rates then increases the right-hand side of the balance sheet for the swap dealer or whoever it is on the other side of the transaction? So we're happy that we're going to receive all that, but so our exposure increases, but then the default risk increases. What do I call this? Alpha incorporated, because they may not have the ability to repay us or to pay us those intermediate payments. Yeah, credit default swaps. There's another good example. Remember, with a credit default swap, I probably own a bond, but I don't have to own a bond. But let's just suppose that I do own a bond, and I'm worried that I'm not going to receive that par value at the maturity date of the bond. And so I pick up the phone and I call a swap dealer and I say, hey, will you pay me my $1,000 if this company doesn't pay me my $1,000? And so the swap dealer, of course, says yes, right? Financial institutions, they're not going to say no. This is what they do for a living. So they say yes. So I have to pay the swap dealer, some quarterly or semi-annual premium over, 3 or 5 years. And then in the event I don't get my $1,000 from the issuing company or entity, then the swap dealer pays me my $1,000. But what happens if the reason that my bond issuer is failing is because of some macroeconomic conditions that leak over to the swap dealer? And so just when I need it the most, the swap dealer says something like, you know what, Jim, I really would love to pay you, but look, we have no money. You can take the chair in my office as payment. And then how about forward contracts? And let's look at this in the example of a hedge. Let's consider an airline who uses a forward contract, and this could be other kinds of derivatives as well, futures contracts, to hedge energy consumption. And so let's suppose that we agree to buy oil at $30 a barrel. But suppose the price of a barrel of oil goes up to $50, all right? So we're so excited. We say to our shareholders, and the executives talk amongst themselves, look, if we would have waited, we'd had to pay 50, but now we're only paying 30. But what happens if whoever had written that forward contract is suffering because the price of oil rises and their balance sheet suffers for a variety of different reasons and they're unable to pay us? So those 5 slides ought to give you some good examples. That takes us back to one of those learning objectives. So it seems to me like really good exam questions would be something like, hey, tell me how this wrong way risk applies to this particular example. Let's go ahead and take a look at some examples of right way risk, which of course is just the opposite of wrong way risk. Let's take an example in the commodity market. Let's suppose we're an oil producer, and of course we sell our oil in the spot market. We benefit when prices rise, so we hope that prices rise, but we know that oil prices go like this, so sometimes they'll fall. So we want to hedge with some kind of a derivative. So let's suppose that we use a forward contract or a swap contract. I mean, the textbook chapter talks about a variety of different contracts to be able to execute this kind of a hedge. But here's the key part of this. Let's suppose that we're only going to hedge 50% of our production. All right. So according to the terms of the contract, the producer agrees to sell, and the counterparty, in this case a swap dealer or somebody else, agrees to buy the oil sometime in the future at $50 a barrel. All right. Now, to understand this right way risk in this example, we need to understand the relationship between the profitability of the oil producer and then how that relates to the likelihood of default. All right, now remember, the oil producer has only hedged half of its production. And so, suppose this is a 6-month contract or a 1-year contract, whatever it is. What's going to happen to oil prices? They're going to go up and down and up and down. So what can happen? Prices could go up or prices could go down. Let's take those two examples here. So as the maturity date of this contract approaches, or the tenor of the swap approaches, let's suppose that the price rises to $100 a barrel, right? Well, this is bad news for the oil producer, right? Because the oil producer is working really hard, digging the oil out of the ground, putting them in a barrel of oil, and they're looking at all their neighbors, and their neighbors are selling for $100, but because of this contract, the oil producer is forced to sell at that $50 a barrel. But remember, this is only a 50% hedge. So if the price in the spot market is 100, then the oil producer is extremely profitable in 50% of its business and will very likely to be able to cover the losses in the derivative, right? So from the perspective of the dealer has tons of exposure, right? We agree to buy at 50 as the dealer when the price is trading at 100. We're getting a great deal, right? So this is right way risk in that we have an extreme probability that we're going to get paid the terms of that derivative contract because the underlying company is so profitable. Now, on the other hand, if the price of a barrel of oil falls, now this gets a little bit trickier, because remember that these oil producers, and this is a great lesson that we learn in early 2020, that at some price it's more efficient for the oil producer to leave the oil in the ground, right? So whatever that number is, let's not worry about that here in this first example. So let's suppose that the price of oil declines to, somewhere around $40 a barrel. All right. So the producer is not profitable. Let's just suppose that break-even point of a spot price of barrel of oil is somewhere around there. But what will happen then is that since it's unprofitable on its 50% of its operations, it's going to look to the derivative to recover some of those losses. Now, if the losses in that spot market are substantial, then the producer is way more likely to default. But here's the case. The dealer's exposure is probably going to be low, right? 50 minus 40 is way different than exposure being high, 50 minus 10, if we ever drop to $10 a barrel. So when the oil producer defaults, of course, the dealer is not happy. It's not like the dealer is high-fiving anybody, but the dealer is going to have relatively low exposure. How about a second example of right-way risk, a call option? Let's suppose we buy a call option on a share of stock. So we have the right but not the obligation to buy a share of stock at some fixed exercise price. So what are we betting on? We're betting on the performance, a strong performance on the underlying company, right? And so let's suppose that the underlying asset has a high and positive correlation to the performance of the counterparty. This is an obvious case of right-way risk, so that as the stock price of the underlying asset goes up, our derivative, our option, is more and more in the money. But since the financial health of our counterparty is tied, right, highly correlated to that underlying company's stock, then we'll have a greater chance that we're going to receive the entire in the money or the entire intrinsic amount of the option. And the obvious notion here is that we get one financial institution to write this option, and it's written on the shares of an underlying stock in a comparable and similar and highly correlated financial institution. So you have the link there. That should make perfect sense. Remember those discussions we had all the way back in our introductory investments class where we talked about stock prices go up and down and we can compute standard deviation in stock returns. And then we said, well, what about diversification? And so we added stocks to the portfolio, and what did we find? We found a downward slope until it was horizontal to the horizontal axis. So standard deviation, the average standard deviation in the equity markets, is around 50%. But the average standard deviation of a well-diversified portfolio like the S&P 500 index is about 15 or 16 or 17%. So you can virtually eliminate unsystematic risk, but you cannot do anything to reduce the level of systematic risk other than choosing the beta of your portfolio. So we have firm-specific information and general economic information working their hands into that decline in the standard deviation through diversification. Well, the same thing holds true here. So we have general wrong way risk. So these are macroeconomic relationships. Of course, there have to be correlations, maybe even high and positive correlations between interest rates and pandemics. There's another word that is going to be in our lexicon every day. Political unrest, inflation, et cetera, et cetera. Oil prices, right? We just talked about those here just a few moments ago. Specific wrong way risk, on the other hand, is like a micro relationship. So specific characteristics within our counterparty. Ratings downgrade, poor earnings, litigation, of course. All right, so back to our conversation about identifying the risk, quantifying the risk, and managing the risk. So if we have these general wrong way exposures, then what we need to do is quantify these correctly, right? So we have to have a good model, and then we have to manage them correctly. We need to enter into the correct derivative contract with the terms outlined so that they meet our specific needs. Of course, there are probably established relationships between and among historical economic data and the level of counterparty risk. Now, of course, in 2020, we're learning that we don't have any idea what the relationship between a pandemic and the economy is, or it might be. And so, of course, what we want to do is develop here, are you ready for this? Maybe this will be my Nobel Prize development today. Let's have a wrong way asset pricing model. We have the capital asset pricing model, and we have the arbitrage pricing model, and we have all these kinds of models. Maybe we need a model to define default risk that incorporates this wrong way risk. Now, on the other hand, specific wrong way risk is probably one that should be avoided or at least transferred. A lot of times it's hard to detect. And that makes it not only difficult, but maybe impossible to model. But of course, we can't stick our head in the sand. So what we're going to do is look at all of the topics that we've discussed in the last chapters, including stress testing and looking at stress test outputs as they relate to all sorts of variables inside of our financial institution. Boy, this is one of my favorite slides here because it brings me back to the multiple econometrics classes I had back in my PhD student days. There are always challenges. I remember my professor would say, okay, here's a model. This is why we like it. And then he would go send us off to collect data, and we'd go out and we'd come back and we'd have these great results. And we'd say, hey, look what we did. Where's our Nobel Prize in economics? And then the professor would just say, chop, 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 chop. Here are all the things wrong with what you've done. All right. Uninformative historical data. I learned this lesson very early on. In a simple example, if you compute a beta over a certain time period and you use quarterly returns versus monthly returns versus daily returns, you get a completely different beta. All right, so what do I have in the bold there? First block point under number 1. Extracting underlying relationships is challenging, and time series and correlation. And so what word did I use earlier on? Heteroscedasticity and serial correlation may not help. Now, I remember sitting in my PhD classes, scratching my head thinking, why did I just do all that stuff if it's not going to help me? Misspecification, of course, this is a huge problem in all types of models, right? You hear this all the time. Correlation doesn't mean causation. And then the direction of wrong way risk is not always clear. Go back to that example that we had with the swap or the forward contract and the 50% hedging. It's kind of an obvious notion that when the oil price goes up, that the oil producer is going to be in a strong financial position. But when oil prices go down, it's a little bit less clear, and we're not quite sure the magnitude of that exposure on the dealer's part as it relates to the financial health of the oil producer. So what do I have in that last block point? Indicate recessions, tough credit conditions, high interest rates, maybe low interest rates, so what we need to do is rely on, getting our arms around all of this information and data and then reaching in and trying to throw out the stuff that's not relevant. This is why we have really smart people like you guys who are working on this day and night. Now, of course, since our beginning discussion on default risk, we use this concept of collateral as a way to reduce that exposure. And remember, in some previous slide decks, I used the example of my Beatles CD collection and the Pink Panther diamond as collateral as a way to reduce exposure. However, collateral is not always perfect, right? If I have the cash, I can give you that as collateral, but I'm probably not going to do that. Maybe I could use Treasury securities. Maybe I could use AAA rated bonds. Maybe I could use some, investment grade municipal bonds or something else, right? Now, the problem is that when the exposure changes gradually, especially when it increases gradually, then collateral is probably an okay and acceptable and a reasonable way to manage this wrong way risk. But what happens if we wake up one day and the world crashes, right? Sky falls in and we have a dramatic fall in oil prices like in April of 2020. Then what happens? Unless we used the Pink Panther diamond as collateral, it's probably not going to help. My Beatles CD collection, nobody's going to really care to listen to a day in the life in a beautiful environment, crisp and clear notes, if they don't have any money to pay their electric bill and their refrigerator bill. Now, we've talked about the importance of these central counterparties, and one of the interesting things is that the central counterparties, they have substantial requirements for collateral. But a lot of times, the initial margins and the maintenance margins, and remember we talked about the default fund contributions, they're probably based on the market risk of some kind of a portfolio. Maybe it's a fixed income, maybe it's an equity portfolio. And the separation of the credit risk and the market risk might, this is not always going to happen, but it might arise in a scenario where that collateral requirement is going to focus on the market risk component and not the wrong way risk component, right? How many of us are thinking about the correlations and the copulas between and among all of those underlying assets. And of course, we should be, right? We should identify the risks. So we've got to identify all of these risks. Now look at that second block point there for credit default swaps. There's an uphill task in trying to quantify this wrong way risk component when setting those margins and the default fund contributions, because typically what happens is that you look at the price volatility, right? It goes like this, and so you set the initial and the maintenance margin at some level that maybe has a 95% confidence or a 99% confidence level, that's going to continue, so that initial margin will be sufficient to cover that exposure. Same thing with the default fund contributions. But, just because we go like this, for the last 25 years doesn't mean that we're not going to go like that or go like that. So look what I have in bold there. Previously highly rated credits can get hit quite hard. Of course, we just have to go back to 2008 to see that, where we have all these mortgage-backed securities and collateralized mortgage obligations and all these other instruments that were tied to the mortgage industry that had AAA ratings when they probably should have had, double C ratings or whatever. Right? Look, I said this to you guys before. We want to be able to quantify the risk so that we can price the risk. And that's what we're trying to do here. Price the credit risk. We've got lots of good models to do that. Price the market risk. We got some good models there. Price the wrong way risk. And that takes us through these just 4 learning objectives. Probably 2 important things here for testing reasons. Not only to describe wrong way risk, but be able to explain some of the examples, and then look at the collateral and how the collateral impacts all this.